Hey everyone, this is a trader investor. In this video, I want to really encourage you to stop trading. Stop trading immediately. And I don't mean quit. I never mean quit anything, because if you are determined to become a profitable, consistently profitable trader, you need to stop what you are doing right now. And here is why. Many times as retail investors, we are not aware why price does what it does. We are not aware turning points and being able to predict them precisely. And by predict, I don't mean price is here, it's going to go here, I'm going to enter. Charts needs to tell us where they want to go. Price is here, the chart is saying price is going to go here, then I enter. I don't just blindly take one point and decide to enter. However, when price is here and you want to go here, but the chart is showing you that price is going to go here first before it goes here, don't be stopped out. That's why I say stop trading immediately. Not to discourage you, but to give you the right tools that you need so that you can take your trading to the next level. Trade with the big players. Trade with institutions who are driving the market. Trade with banks, with pension funds, with hedge funds who are putting millions and billions of dollars behind their trades. Just go with them. There's no need to go against them, and there's no need to try to anticipate them, move ahead of time and go with them, right? And if you say I'm going to go with them, but I'm going to enter it a little bit earlier, this is where they'll get you. You want to anticipate what they could do, let them do it, and then follow. In a 100-point move, you don't need to capture all 100 points to be consistently profitable. You don't need to capture 80 points to be consistently profitable. You want to capture somewhere between 50 and 80. Because you never know the real turning point, whether at an entry or at an exit. You don't know when those occur. So what do we look for, and how do we prevent from being whipsawed in and out of positions, whipsawed in and out of profitable trades? How do you prevent all of that? And there are crumb trails that the market leaves behind that is telling us what they want to do. So this is what I want to focus this video on. I want you to have an edge before you trade. And that edge comes from learning a very simple trick. And this trick I have talked about multiple times. I've said liquidity, manipulation, order blocks. I've talked a lot about this, but in this video, I'm just going to purely focus on liquidity. If you don't understand anything else, but you grasp the idea of liquidity, then you know how to prepare for your trades. So let's just dive right into it, and we'll take Tesla as an example. You know, most of my trades, I focus on the 4 ETFs up here, but for the purpose of illustrating this concept, any instrument, any asset class that you use can be implemented. So it can be crypto, it can be futures, it can be forex, it can be stocks, it can be options. Anything that you trade, you can implement this theory. You can implement this concept. So as we look at Tesla, I have drawn a couple of lines and I call them liquidity. Why is that? Why did I call them liquidity? So what liquidity is, in a nutshell, is an area where most retail investors have learned to think of support and resistance. And the teaching is the more times it touches, the stronger that support and resistance. It could also mean the more times that it touches, it's been hammered, and it's going to collapse. It could also mean that, right? If you hit the ceiling with a hammer multiple times, eventually it will collapse. So ceiling or floor, same concept. So just because it has been there multiple times and rejected, it doesn't mean it has to take place again and again. So that's why the idea of liquidity is important. The idea that once we understand where markets could react in a certain way, then we are prepared to take action based on that understanding. So as an example is price comes down, reverses, immediately the thinking is at that low point, draw a support line, and the next time price comes down to that level, it could bounce back. That's the idea. Or if it breaks that level, it's going to continue to go down. So that's kind of a dangerous thinking, because you could be 100% right in the long-term outlook, but you could be 100% wrong in the timing of your position and being taken out of the position with a stop on either side of that entry. Whether you wanted to take a bounce, you get manipulated out by a stop because price will go further down first, or you take the break of that support and you get manipulated out because price reverses, stops you out, and then it could continue to keep going down. So let's just look two examples, for example, in Tesla. Let's start with the first one here. So price came down, had a strong rejection at this level, and let's not worry why. We could start looking at order blocks and supply zone, demand zones, at imbalances, and find out this could be why, but let's not worry about that because most retailers are not aware of that anyway. So price comes down, gets strongly rejected, and price reverses. Again, price goes up, gets rejected because we have body to body engulfing, and price just keeps continuing to go down. So here at this moment when price comes all the way down here, what is the action plan? So if anybody has a buy stop or a buy limit, in this case, if anybody has a buy limit and they said as soon as price touches here, I want to enter, then that price went all the way down here before it reversed. And even then, when it reversed, it didn't go as high as you wanted it to go. Your risk to reward ratio 2-to-1 could not be exercised, even if you had waited for price to come here, to come back down, to come here and enter at the break of these highs, maybe as an example, and have this as the stop, these lows, and you want to target 2. That never happened. That never happened. You got stopped out. So, you're waiting for this bounce to go long, you get stopped out. You see this break, you go short, you get stopped out. On either side, you're stopped out. So this is why once you understand liquidity meaning there are potential buy orders, sell orders sitting around this area, because it's an area, it's a zone. When you have those multiple types of orders sitting here, it is easy for those who have access to this level of data, and their access does not say the trader investor has a buy order here or a sell order there. It just says cumulatively there are traders who have a buy order here, a sell order here, a stop here. So they know all of that, and it doesn't even have to say stop. All it does is, okay, there's a buy order here and there's a sell order here. A stop loss on a long position is a sell order, and a stop loss on a short position is a buy order. So that's how they know whether it's a buy or sell. If they see a bunch of buys here and a little bit down below they see a bunch of sells, they know these are stops. So they can easily hunt for those stops. So you don't want to be hunted, right? You want to go along with the hunter, and when the hunter is done hunting, you just want to collect what they want to provide to you. So not, like I said, not the 100%, somewhere between 50 and 80% of that move. Once you collect that, you're golden. So here, price, like I said, price came down. This bounce was not a good enough bounce. You got stopped out if you took it right away. You got stopped out if you were patient and waited. And part of the reason is we need to see a break of structure to enter. There's no indication here as price comes down, makes a low. It's not making any higher highs, so there's no break of structure to enter. That's why this liquidity area is fair game for this big money traders to come in and manipulate this area. So those who went short got stopped out with the next few hours. Those who went long at this bounce, or those who kind of waited for this to happen, they also got stopped out, whether same bar or next day when price didn't go as high as they needed it to go, they were stopped out. That's why this liquidity area is important. Now if we look at the other side, so I mentioned price came down, came back up, got rejected. So this is liquidity area. Remember, it's a zone, not a point. So, you know, this somewhere in this area is a zone, and price got rejected, and the next time it comes here, here's a trap. Here's a fantastic trap that we can see here, and I'll tell you why it's a trap. So many traders, retailers, they see this as resistance. Price broke out because this gap up, right, from the 1st of April to the 5th, which is over a weekend, right? Because the second was non-market Friday. It was Good Friday, so there was no trading that day. And so the 5th, the market gave you a very significant gap up. So anybody who saw this wanted to take this long. And what happens? The same hour, they get manipulated out. They get stopped out. Immediately, they get stopped out. And if anybody saw this and entered a short position right here, if their stop was wide enough, they're safe. But on a move, on a stock like Tesla, many people want to have tighter stop because big stops means big losses. So if you had a tighter stop, maybe at the high of this bar, you get manipulated out. So on both sides, you get manipulated out. So what's the moral of this portion is, just because you see a breakout, you want to see a confirmation of that breakout. And what is the confirmation of that breakout? Price continues to drive up. It tests this support and drives back up. This is your confirmation and this is your entry. That's how you know that the manipulation is over. But at this phase, we don't know that the manipulation is over when we are at this bar. When this happens, we have no clue what happened, what is next. All we know is don't buy at this breakout, wait, and then, you know, next few hours, all of those people who have gone long are taken care of by this stop. And anybody who has gone short, maybe they were lucky enough that their stop was wide, but because price came down. But here's my problem with the second part. Let's say I'm lucky and I entered here and I have my stop at the high here, but I want to make at least twice as much as my stop. So a couple of days later I close my position. But what my problem is with this setup, it is not always that you get this position to close in your favor. Many times the manipulation has to take place first. And even if you were lucky in this one, Then the next one where people will make a mistake is, okay, we broke these lows, let me enter here. Let me enter here at the break of these lows, and I'm going to make this a very tight stop, and I'm going to target again 2, and that never happens because price reversed. And where did it reverse to? To that liquidity line. That liquidity line held 1, 2, 3, 4, 5, 6, 7 hours, almost 7 hours in that zone, because as I mentioned, it's a zone, not a specific area. Because it's a zone, it held, and anybody who said, oh, it broke out, let me go long, they get stopped out unless they have a very wide stop. I don't like having wide stops and, you know, giving myself a lot of risk. But if you're okay with that risk, that's okay. Understanding that this is an area of manipulation, I want a confirmation of this manipulation. One way to confirm, if you don't want to wait for price to, if you don't want to wait for this, if you think this is a late entry in this instance, because the reason that I can say that is price has been making higher highs and higher lows. So that has been very, very obvious. We're making higher lows. We're making higher lows. So we continue to drive up. So that's very obvious. So when something like that happens, I'm okay to say I am going to look at this bull flag and I can enter at the break of this flag, because I know it's been manipulated out. I know if anybody who has not taken their profits, thinking it's Tesla, I want to target these areas down here, I want to target these areas down here, then for those people who have not exercised their right to take profit, yeah, and if they have stayed in their positions, they are out here as well. So this liquidity line has worked on both sides. So because that is taken care of, you can say this is a bull flag, I'm going to take the next entry, which is not a bad analysis and not a bad thing to do. You just have to understand this is a liquidity area that I want to make sure that I understand what it does around this area. I'm not entering just because it broke that area. So it's really, really critical to understand that. That's why I want to show you some of these bigger names. Some of these bigger names are important to understand. So if we take Netflix as an example, before earnings, we had made this area, right? We have made this area and we have some liquidity, but in this instance, it did not give us any chance at all. There was no chance for us to say, did it come and test this area for my entry to go from the 540 to the 500 area? That chance never came. However, when you know that this liquidity is here, you can prepare for your trades. I'd never recommend trading around earnings. I'm just saying if earning was not this date, you know liquidity, you can start to prepare for that trade. And if you see what keeps happening is this support line here became resistance line here. And what happened at that resistance line? So let's zoom out. So price came here, bounced, and remember, not every time it goes there, it bounces, there's manipulation, because they have to make you believe this thing works. There's always a bounce. So the third time there's an entry, you say, oh, price has gone up, there's a breakout, I'm entering. No, wrong, it's down. And then here as well, price on April 1st at 11:30 Pacific time, it reached this high, it gave me this doji, it's gonna go down. So if I enter short here, the very next 2 bars take care of my stops as well. So price just gets manipulated out, but we know the institutions want to drive this price higher and higher. And then that liquidity line now becomes another liquidity line here. So make sure that as it's bouncing, there's a potential of manipulation. For me, the bounce, the reason why I can stay away from this bounce is once it bounces and I want to see a high, but I want to see a higher low and then new high, and I want to see recent highs broken. This is what I say this down move has terminated its pullback. Now when that termination point is so far up, I skip this trade. There's no reason for me to rush and get into a trade and chase it. If it has moved before I participated, well be it, move on and find the next opportunity. So what's important is understanding these levels and stop trading before you understand these levels. That's really the basic concept that I want to instill in you today is do not trade until you're aware and comfortable with understanding any area that you draw as support and resistance could become an area for manipulation. And if it's an area for manipulation, then just be very careful with it. Don't forget to like this video. It tells me you have learned from it. It tells me you're going to take advantage of it and encourages me to keep doing more. And I will continue to bring you additional resources, additional tools that you can add to your tool set so that you can become a better trader and have an edge for your trading. All right, everyone, take care and have a great weekend.